Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 3-1 question number 2. This is the structured Paper 3 which consists of 3 questions. Each of them will be of 30 marks and the total time limit for this paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. TPLC is a business which occupies rented premises. It has only 2 types of non-current assets. It provided the following information about carrying values of these 2 assets. Carrying values just means the net book values. We have the values at 31st December 2023 as well as 2022. So these will act as our opening balances and these will act as the closing balances. We have 2 types of non-current assets. The first one is machinery, second one is motor vehicle. The company also provided the following additional information. The first one is that depreciation is calculated as follows. For machinery, we are using the rate of 10% and the method that we are using is the straight line method. It means that we can multiply this rate of 10% to the cost itself in order to calculate our depreciation charge for the year. Then for motor vehicle, the rate per annum is 20% and the method that we are using is the reducing balance method. Under reducing balance method, we need to multiply this given rate to the net book value instead of the cost. Net book value is just going to be the difference between our cost and the accumulated depreciation, which is also known as provision for depreciation. Then depreciation is calculated in accordance with the months of ownership. It means that for whatever month we are owning the particular non-current asset, we have to charge depreciation according to the months. TPLC operates 2 machines and 1 vehicle. Machine A was bought for 90,000 on 1st July 2019. Machine B was bought on 1st October 2020. The vehicle was bought for 40,000 on 1st January 2021. Machine A was then sold on 1st February 2023. Machine C was bought on the same date for 150,000. On 31st December 2023, that's our closing date, after the depreciation for the year had been provided, an impairment review indicated that there was an impairment loss of 2,480 on the vehicle. Remember that impairment loss is just the difference between our carrying amount and the recoverable amount. Okay, now for the first part of this question, we need to calculate at 31st December 2022 the accumulated depreciation on machine A. Remember, for machine, we are using our straight line method and we need to provide depreciation on a monthly basis. So we can just calculate the months for which machine A was used since its purchase date till the date of 31st December 2022. So that will be for the years 2019, 2020, 2021 and 2022. In the year 2019, the machine A was bought on 1st July 2019. So it means that we only used it for 6 months. For 2020, we used it for the entire year, so 12 months. For 2021, again 12 months. And for 2022 as well, we used it for 12 months. So in total, we used the machine A, which was bought on 1st July 2019 for 6 plus 12 plus 12 plus 12, which is 42 months. So we need to calculate the depreciation for 42 months. And we have the cost to be 90,000 and the rate per annum is 10%. So that is just going to be our cost times 10%. This will give us the depreciation charge for 1 year. If we divide it by 12, we get the depreciation charge for 1 month. And we know that we utilized machine A for a total of 42 months. So if we multiply it by 42, we get the depreciation for those 42 months, which will act as the accumulated depreciation at the date of 31st December 2022. This results in the value of 31,500. Now for the second part, we need the carrying value of machine B. Okay, I think we have been given the carrying value at the date of 31st December 2022, which is this one, the opening balances, and we are looking for machinery. So this is the total carrying value for machinery, and we know that we have 2 machines at the date of 31st December 2022, machine A and machine B. We've already calculated the accumulated depreciation for machine A, and we also know that the cost for machine A was 90,000. So we can first calculate the carrying value for machine A. Carrying value is just the net book value. So that is going to be the cost minus the accumulated depreciation. Cost for machine A was given to be 90,000. We just calculated the accumulated depreciation to be 31,500, which results in the value of 58,500. And now we have the total carrying value, which is 151,500. So carrying value of machine B is just going to be the total carrying value minus the carrying value of machine A. The total carrying value was given to be 151,500. We calculated the carrying value of machine A to be 58,500. This results in the value of 93,000. Then we need to calculate the original cost of machine B. Okay, remember that for machine we are utilizing the straight line method. And we had been told that machine B was bought on 1st October 2020. So let us count the months. For 2020, it was used in the months of October, November and December. So 3 months. In the year 2021, we used it for the entire year. So that will be 12 months. And the same goes for the year 2022 as well. So the total number of months for which the company used machine B is going to be 3 plus 12 plus 12, which is 27 months. Okay. Now we already have the carrying value of machine B. Remember that the carrying value is just the cost minus the accumulated depreciation. And we just calculated that machine B was used for a total of 27 months. So we're trying to calculate the cost. Accumulated depreciation is just going to be cost times 10%. This will give us the depreciation charge for 1 year. If you divide it by 12, we get the depreciation charge for 1 month. And if you multiply it by 27, we get the accumulated depreciation for the entire period in which we use machine B. So this will again be equal to 93,000. Now we can just take the cost common. So we have 93,000 equals to, if you take cost common, that will be 1 minus 10% times 27 divided by 12. So now we can just easily calculate the cost. That will be equal to 93,000 divided by 1 minus 10% times 27 divided by 12. This results in the value of 120,000. Alright, that is all for the first part. Let's move towards the next one. We now have to prepare the schedule of non-current assets at 31st December 2023. We're talking about TPLC. We need to prepare the schedule of non-current assets. This is at 31st December 2023. Okay. And if we are preparing the schedule of non-current assets, we are preparing it for property, plant and equipment. And in this case, we only have 2 categories of our non-current assets. So that will be our plant and machinery for the first one. And the second one was motor vehicles. And we also need to prepare a totals column unless the question states that you do not need to prepare it. Okay, for the schedule of non-current assets, we have 3 different sections. The first one will deal with all of our cost. So we start with the cost of existing non-current asset at the opening date, which in this case is 1st January 2023. Okay, at the date of 1st January 2023, the company had 2 different machines and 1 vehicle. Machine A was bought for 90,000 and we also have machine B, for which we calculated the cost to be 120,000. So the total cost of plant and machinery existing at the date of 1st January 2023 will be 90,000 plus 120,000, which results in 210,000. Let's write it down. Then we only had 1 motor vehicle at the opening date, which was bought for 40,000. That is the cost. So we just need to write down 40,000. And the total cost will be 210,000 plus 40,000, which results in 250,000. Now, if there is any additions of the non-current assets, we need to add their cost as well. And in this case, we purchased a new machinery, machine C, at the date of 1st February 2023. And the cost of machine C was given to be 150,000. So we just need to include it. And there is no addition for motor vehicle. So the total will still be 150,000. Then if there are any disposals during the year, we need to remove the cost of the disposed non-current asset as well. And at the date of purchasing machine C, machine A was also sold. So now we need to remove the cost of machine A. We can see that the cost for machine A was 90,000. So we just need to subtract it. Okay, we also have impairment information. On 31st December 2023, after the depreciation for the year had been provided, an impairment review indicated that there was an impairment loss of 2,480 on the vehicle. Remember that impairment is treated similarly to revaluation. Whenever there is impairment, we treat the recoverable amount as the revalued amount. So the cost at the closing date, at the date of 31st December 2023, should now be equal to the recoverable amount. We need that. And in order to calculate the recoverable amount, we first need to calculate the carrying amount at the date of 31st December 2023. In this case, we have been given the opening net book value of 25,600 and the rate for motor vehicle is 20% using the reducing balance method. So we can first calculate the depreciation charge for the year. This one is for the motor vehicle. We just need to multiply the rate of 20% to the given value 25,600. So that will be 25,600 times 20%, which results in 5,120. Now this is the depreciation charge for the year. In order to figure out the carrying amount at the closing date, we start with the carrying amount at the starting date and subtract the depreciation charge for the year, because the depreciation of current year will definitely reduce our net book value. The starting amount was 25,600. Now we just need to subtract the depreciation we calculated, 5,120, which results in the value of 20,480. This is our carrying amount. Now if we include this amount here, we can easily solve for the recoverable amount. So the recoverable amount will be equal to 20,480 minus 2,480, which results in 18,000. So this is the new cost to be shown at the closing date for our motor vehicle, and we need to adjust the required amount accordingly under the heading of impairment. Okay, this is at 31st December 2023. Now the closing value for motor vehicle should be equal to the recoverable amount after the impairment, which is 18,000. Okay, there is no impact of impairment on plant and machinery, so let's calculate the cost at 31st December 2023. That will be 210,000 plus 150,000 minus 90,000, which results in 270,000. Now for the impairment amount to be included here, we can just create an equation. So we are starting with 40,000. We need to subtract a certain amount so that we get the value of 18,000. So the amount to be subtracted will be equal to 40,000 minus 18,000. Which results in 22,000. So the total impairment will also be 22,000. Now the total of the cost at the closing date will be 250,000 plus 150,000 minus 90,000 minus 22,000, which results in 288,000. Okay, we are done with the first section. The second section will deal with our depreciation. Okay. We can start with the opening accumulated depreciation. So this will be at 1st January 2023. Okay. At the opening date, we have been given the net book values instead. And we already have the cost as well. The cost for machinery was 90,000 and 120,000, which was 210. And the cost for motor vehicle was given to be 40,000. And at the opening date for the depreciation section, we are looking for the accumulated depreciation. So we know that the formula for net book value is cost minus accumulated depreciation. Now if we need to figure out the accumulated depreciation, it will be cost minus the net book value. We have our cost right here. We have the net book value right here. So for machinery, the accumulated depreciation at the opening date will be equal to 210,000 minus 151,500, which results in 58,500. Let's write it down. 58,500. Then we repeat the same process for the motor vehicle as well. For motor vehicle, the cost was 40,000 and the net book value is 25,600. So the accumulated depreciation will be equal to 40,000 minus 25,600, which results in 14,400. Okay, so the total of the accumulated depreciation will be 58,500 plus 14,400, which results in 72,900. Then let us include the charge for the year. Okay, so for plant and machinery, we have 3 different machines. Remember that machine A was sold on 1st February 2023. It means that machine A for this year was only used in the month of January. We need the depreciation. For machine A, that will be 90,000 times 10%. This will give us the depreciation for 12 months, but we only want it for 1 month. So times 1 by 12, it results in 750. Now we need to calculate the depreciation for machine B as well, and in this case machine B was used for the entire 12 months in the year of 2023. We have already calculated its cost to be 120,000 times 10%. This will result in the value of 12,000. Then machine C was bought at the date of 1st February 2023, which means that it was used for 11 months in the year of 2023. We need to calculate the corresponding depreciation as well, and the cost for machine C is given to be 150,000. So 150,000 times 10%, we are looking for 11 months, times 11 by 12. This results in the value of 13,750. Now we need to calculate the total depreciation for our plant and machinery. That will be 750 plus 12,000 plus 13,750, which results in the value of 26,500. Let's write it down. And we need to add this value, not subtract it, because in this case we're trying to calculate the total of the accumulated depreciation, and the depreciation charge for the year will definitely increase the value of that accumulated depreciation. So we always need to add it back, not subtract it. Then we need to calculate the depreciation for the year 2023 for motor vehicles. But in this case, I think we've already done that. We've calculated the depreciation for motor vehicle right here. It was 5,120. Let's write it down. The total depreciation charge for the year will be 26,500 plus 5,120, which results in 31,620. Then in this case, there was disposal as well. Whenever there is disposal, in the cost section, we subtract the cost. Now within the depreciation section, we need to subtract the accumulated depreciation of the disposed non-current asset. In this case, we're talking about machine A. We've already calculated the accumulated depreciation till the date of 31st December 2022. Now in order to figure out the total accumulated depreciation, we just need to include the depreciation charge in the year 2023 for machine A, which we have already calculated before. That was 750. So we just need to increase this value of 31,500 by 750. This results in the value of 32,250. Now we need to subtract it, because if something is disposed, then we should no longer be including its cost as well as the accumulated depreciation. 32,250. So the total will also be 32,250. Then in this case, we also have impairment. Now, whenever there is impairment, whatever accumulated depreciation we had before the date of impairment, we need to remove all of it. So we're just subtracting everything. In this case, the impairment was at the date of 31st December 2023. So before this date, which means all of the depreciation values, we need to remove that. Let's see, at the opening date we had 14,400, and during the year we had depreciation of 5,120. So the total value that we need to remove will be 14,400 plus 5,120, which results in the value of 19,520. Let's subtract it. That's the total as well. Okay, now we can calculate the accumulated depreciation at the closing date, 31st December 2023. Okay, for plant and machinery, that will be 58,500 plus 26,500 minus 32,250, which results in 52,750. Then for motor vehicle, that will be 14,400 plus 5,120 minus 19,520, which results in 0. And for the total, that will be 72,900 plus 31,620 minus 32,250 minus 19,520, which results in 52,750. We are done with the second section as well. For the third section, we deal with the carrying amount. Okay. And while writing down the carrying amount, we always start with the closing value first. So at 31st December 2023 and at 1st January 2023. For the closing date, we already have the cost as well as the accumulated depreciation. So this is just going to be our cost at the closing date minus the accumulated depreciation at the closing date. So for plant and machinery, that will be 270,000 minus 52,750, which results in the value of 217,250. For motor vehicle, that will be 18,000 minus 0, which is again 18,000. And for the total, that will be 288,000 minus 52,750, which results in 235,250. For the opening date, we have been given the values of our net book value, so we can just include that, 151,500 and 25,600. So 151,500 and 25,600, and the total will be 151,500 plus 25,600, which results in 177,100. Okay, and in this case we have been given the workings as well, so you need to show all of these workings that we did, these as well. Then we did these workings for the depreciation. You need to show all of it within that particular box so that you get your markings correctly. Alright, that's all for the second part. Now, for the third one, we have some additional information. The directors use ratio analysis to assess performance. Name the efficiency ratio which would be affected by the outcome of the impairment review. The impairment review will change the net book value of the non-current asset, and we use the net book value of our non-current asset in order to calculate the non-current asset turnover. So that is the answer we're looking for. Alright, that's all for the third part. Let's move towards the fourth one. Now we have been given some additional information. Revenue for the year ended 31st December 2023 was 322,500. We have been given the assets and liabilities at the opening date as well as the closing date. Then the directors calculate ratios using year-end balances. They are now considering using average figures in future. We need to calculate the net working assets to revenue ratio for 31st December 2023 using year-end balances. Year-end means that we are using the closing balances. We should not be looking at the opening balances for this part. Okay, the first thing we need to calculate is the net working assets. Okay, net working assets is just going to be inventory plus trade receivables minus trade payables. So for the closing date, that will be 112,000 plus 48,000 minus 31,000, which results in 129,000. Then the net working assets to revenue ratio is just going to be the value of net working assets divided by revenue, and in this case we show it in terms of percentage, so we also need to multiply it by 100. We've already calculated the net working assets, so that's 129,000, and in this case we have been given the revenue as well, 322,500. If we multiply it by 100, we get the value of 40%. That is the answer we're looking for. That's all for the fourth part. Now for the fifth one, we need to assess the effect the change in formula would have on the company's net working assets to revenue ratio. The calculations are not required. The change in this case is that currently we are using the year-end balances. Now they are considering using average figures. Now in this case, we can just calculate the net working assets at the opening balance. That will just be 76,000 plus 56,000 minus 29,000, which results in 103,000. So this is the opening balance, this is the closing balance. If the opening balance is lower than the closing balance, it means that the average figure will also be lower. If the average net working asset is lower, this is the value we use within our numerator. So if the numerator value is decreasing, then the overall figure will also decrease. That will be the impact. Let's write it down. Because the value of the net working assets has increased during the year the average value would be lower than the closing value, and this would cause the ratio to be lower. Alright, that's all for this part. Let's move towards the next one. The perceived performance of the company. In order to answer this, we first need to know what is meant by the net working assets to revenue ratio. So this just means that by using what amount of net working assets can the business generate what amount of revenue. So in this case, the lower ratio would be preferred because that would mean that business is successful in generating a higher level of revenue by using a low level of net working assets. Now, the change in the formula would result in our average net working asset value to be lower than that of our closing balance of the net working assets, and the revenue will still remain the same. So the perceived performance of the company would be that the company is successful in generating the same amount of revenue by using even lower amount of our net working assets. Let's write it down. The lower ratio makes the business look more efficient, as the business seems to require fewer net working assets to generate the same amount of revenue. That is all for the fifth part. Let's move towards the sixth one. We now need to advise the directors whether or not they should use average figures when calculating the net working assets to revenue ratio in the future. We need to justify our answer. This is a 5 marks, so we need 2 advantages or 2 points on why they should change to average figures, 2 points on why they should not change to average figures, and then a final decision. Okay, so we can label it as for and against. So for changing to the average figures from the year-end figures, the very first point would be that the sales will take place throughout the year and not just at the closing date. That's why the average figures would be more relevant. Sales take place throughout the year, not just at the year end. Then the second comment would be that if we use the closing balance of our net working assets, then changes during the end period might have a higher impact. So it might distort the actual result. But if we were to use average figures, then we would be utilizing the figures over the year, and that would smooth out any distortion that took place during the end of the year. Let's write it down. Changes arising late on in the year would distort the result less if an average was used. Okay, now we need points against changing towards the average figures from our closing balance. The very first point we can write down is that changing the method of calculation will not have any effect on the actual performance. So change in calculation would not have any effect on actual performance. Then the second point that we can write against changing towards average figures is that in order to assess our performance, we need to use consistent calculations. We need to be consistent with our calculation. And if we are using the year-end figure for everything, we cannot just change the figure for our net working asset for average figures. Let's write it down. The assessment of performance requires consistency in calculation. Okay, these are all the points. Now, based on these factors, we need to make a final decision. Okay, in this case, I would advise the directors to not use the average figures because the changes in the net working assets do not take place evenly throughout the year. So even the average figure will not provide a more accurate information on the actual performance. The directors should not use average figures when calculating the net working assets to revenue ratio in the future, as changes in net working assets do not take place evenly throughout the year. Alright, that is all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.